Good evening, everybody. In line with the theme for tonight, I've set up my short presentation on business model, responsive risk-based transformation. So there's a lot in that it's responsive to members' needs, but it's risk-based and it is transformation. And key to that is what we're seeing at the moment. If we project forward for many credit unions, we're seeing an unsustainable trajectory in credit union performance, and this is happening for a lot now, not for everybody, but it is a worrying trend that's beginning to emerge. And what the key drivers of this is that savings and the success of savings are actually driving balance sheet growth. So balance sheets are growing quite strongly, which should be a positive sign. But because of the mix in the balance sheet, the loan to total asset ratio being an aggregate now 27%, and the decline in yield and investments, the potential to generate, and of course upward rising costs as well. It's the costs keep going up year on year. At the level of surplus that we are looking at and we're projecting forward is not going to be strong enough to sustain the existing capital buffers. And by that we mean the difference between the regulatory minimum of 10% and what might be held on the balance sheet today. So quite a number of credit unions are beginning to show this trend line. And clearly it's unsustainable, because over time what happens is that financial stability certainly comes under some pressure and some degree of expectation and response from ourselves. So on the left-hand side, we've got some quite strong instability drivers. The level of lending, as we all know, is too low. And in many respects, we're all faced with what Gabriel Fagan termed recently a creditless recovery, which is quite unusual. We've got a strong economic recovery, but it's creditless. The level of borrowing that one might expect is not as strong as it would be in other circumstances, and you're feeling the effects of that, of course, with the continuing depressed nature of consumer borrowing when it comes particularly to short term. The cost of doing business inexorably increases year on year. Simply if you just open the door, your costs are going to go up. We all know that. And then finally, that key point, that very strong savings growth is pushing balance sheets. You're growing fast, but the buffers are coming under some pressure as you're doing that. On the other side, there are, of course, viability drivers, and the key for us and from our perspective is the boards and management of credit unions. Clearly, there's that degree of competence that's required to deliver on deliver on the challenges or deliver on the solutions, should I say, that the challengers are throwing up. And increasingly, we're seeing that people are much more focused on what these challenges are, but more importantly, they're focusing in on what the solutions may be. And this is driving, if you like, a really good look at balance sheet transformation, what elements of the balance sheet need to be changed, and as a result of that, then what business model change and transformation occurs when you're faced with these challenges. And of course, as Patrick alluded to in his own speech, members' expectations are largely driving the response of financial services firms. You remember last year when I was talking to you, I pulled out my mobile phone and I said, well, look, that is your platform for the future. And so lots of business models are now being designed around these sort of platforms. And how do you respond to that? How do you increase your own level of learning by using social media platforms, etc.? How do you reduce the cost of doing business? Because competitors are certainly doing that. And that's all leading to a whole focus on new business activities. And current accounts and debit cards are one. There's a focus now on longer-term lending and mortgages. And I have no doubt that there'll be a focus on other business activities as time goes on. That's all leading towards a concentration on business model transformation. So what are we seeing? Well, our experience so far is of one of well-grounded proposals that have been rationally and thoughtfully worked through, where there is a clear business case, where there is a clear rationale and a logic around delivering member value through new services or through new channels, or looking at changing the prudential limits that we may have in place for long-term lending, but doing that in a very structured and a carefully risk-based way. We're also seeing some proposals that are underdeveloped. In these cases, they're at concept level. There are some ideas there, but they're still very much at concept level, and the thinking hasn't been put in around the business model itself. Or what does that mean from a business model perspective, and what type of changes will flow from that? So well-grounded proposals are realistic, they're achievable, and they're risk-based. And there's a growing emphasis on realism, on the achievability of that, but also there's a growing emphasis on what is the impact on the existing business model. It's not enough to change, but you also have to think about, well, where am I today, what's my risk profile, and then what is the impact if I'm to take on this additional business on my existing profile? Is that sustainable? Have I got the resources and the capabilities as an individual credit union, or increasingly, as credit unions are beginning to realise, do I need to collaborate closely and commercially with other credit unions? We're beginning to see, of course, the emergence of shared service facilities as being an option or as part of the structure in the way credit unions are responding to challenges. So what are our capabilities? Many people look to the central bank here. What can we do? Well, we have a range of flexibilities, and these are largely contained in the amendments that were made to the 97 Act. In the first place, we can change or we can issue regulations along with conditions. And those people who are involved with the MCAS service are aware of the conditions and the requirements, or if you like, the regulatory and the supervisory framework that we have created around that additional service. And this is something that's quite important. We can change prudential balance sheet limits. We can change and look at the classes of loans or the classes of investments, as Anna Marie was referring to earlier, or indeed we could look to exempt certain services using the regulatory approach. And as I've mentioned, we can also approve additional services. And that's possibly one of the most flexible tools in the toolkit, and it really depends on what I was talking about just one slide earlier, on solid, robust, achievable, realistic and risk-based business cases that demonstrate that there is a need, number one, for the services, but that there's a very careful and thoughtful process put in place to develop and implement those services. Our process, it's quite straightforward. It very much reflects the additional service process, but it's one that we will adopt for any reasonable business case. We'll have an informal engagement, typically on a draft business case where a group of credit unions or credit union or indeed trade associations have come together and they're producing a high-level business case of what it is they'd like to explore. We will give some indication of what our risk considerations for that will be. That leads then to a formal engagement with a full business case proposal. This is where we're really looking at real and substantial change and what the impact of that might be on credit unions, what degree of flexibility, what degree of response is required of us using the different capabilities that we've got. In terms of additional services, we then move to another stage, which is saying we're minded to consider this. We think this is a good idea. We believe it's in the interests of your members. And then we move forward into a formal engagement and a formal consideration of that change proposal. That finally leads to a response, or an outcome if you like, and that outcome may result in additional service approvals, as in the case of members' personal current account services, which is very much a legal process prescribed in the Credit Union Act. It may lead to changes in regulations. We may find that a current regulation needs to be tweaked, or that it's out of date, needs to be modernised, and that's an adjustment to existing regulations. And then finally, the replacement of existing regulations and or the definition of new regulations, and that normally or typically takes a full consultation process. So that's my part of the presentation over. Thank you for listening to me. I think we're taking a break now. Or no, we're taking a break for Q&A, questions and answers. Thank you, ladies and gentlemen.